Meet Jane. Like you, she's interested in using a margin loan. And like you, Jane struggles with understanding how margin works. Investing with margin is essentially borrowing money from a broker to purchase securities or use as a personal collateral loan. To use margin, you must first post collateral in the form of securities such as stocks, bonds, or ETFs. Upon drawing on your margin, you will begin to accrue interest. Your margin availability is directly tied to the value of your collateral. You're able to borrow up to 50% loan to value. You can pay off your balance or cover a margin call by selling or depositing securities. Let's take a look at an example. To purchase 100 shares of an $80 stock on margin, you would invest $4,000 of your own funds. You would borrow $4,000 on margin from TD Ameritrade, giving you a total stock purchase of $8,000. If the stock price was to rise to $85 per share, you have your original investment of $4,000, the $4,000 you borrowed on margin from TD Ameritrade, with a $500 profit. Your total stock value is now $8,500. The value remaining after paying off the money borrowed on margin from TD Ameritrade is $4,500. Let's say the stock price decreases to $75 per share. You have your original $4,000 investment, the $4,000 you borrowed on margin from TD Ameritrade, and a $500 loss. The total stock value is now $7,500. The value remaining after paying the money borrowed on margin from TD Ameritrade back is $3,500. What can margin be used for? Is margin only for purchasing securities? No. Margin can be used for a wide range of personal financial needs, including consolidating or refinancing debt, paying off a higher rate mortgage or buying additional properties, paying off college costs, starting a business, or taking a dream vacation. What are the benefits? A revolving line of credit, easy access to funds via check, Fed funds wire, or electronic funds transfer. With no credit check, setup is quick and simple. Collateral-based loans are not reported to credit bureaus. What are the risks? If the equity in your portfolio falls below the minimum maintenance requirement, you will have to deposit additional cash or collateral. If you cannot meet your minimum, you could be subject to a margin call and may have to sell securities from your portfolio with or without prior approval. Before borrowing on margin, be sure to discuss with our team the risks associated with margin loans and have a risk mitigation strategy in place. How does the process work? A client opens a new account with the Capital CS Group by executing new account paperwork, including an account application, margin lending agreement, money movement electronic funds transfer form, transfer request. The account is funded by transferring an existing portfolio or depositing money market funds. Processing time is 3 to 5 business days. Once the assets arrive, the needed funds can be sent out via electronic funds transfer to your bank account or wire transfer. Jane is going to call her advisor today and begin her margin account application. For additional information, please call us toll-free at 1-844-390-2797 or visit us at www.capitalcsgroup.com.